So if you see what I'll just say, for lack of a better term, blood in the water, and you see what's not some group out there seemingly paying what you think to be a very, very, very aggressive price. So examples would be things we saw last year. And they come to you to make their numbers work, and you're a bridge lender. And you say, all right, I'll give you that bridge loan. I wouldn't say it doesn't happen where the bridge lender is thinking to themselves, which I think is what you're asking, that this group is likely going to be in trouble.
Hi, Adam Gower here, founder of Gower Crowd. And in this first guest episode of Series 5 of the Gower Crowd podcast, the real estate reality show, you're going to be meeting with David Saxe, who is managing principal at Calvera Partners. Now, David has lived through prior real estate downturns, working as an analyst and VP in his various positions, one as an analyst and then another as VP of investments at major institutional commercial real estate companies. In today's podcast, the first guest podcast in this new series, David will discuss how distress is filtering its way into the commercial real estate investing world. We discuss the impact of rising interest rates on cap rates and consequently on asset values, and how this is leading to an increased flow of distressed opportunities across all asset classes, including GASP multifamily. David shares his insights into how sophisticated sponsors mitigate risk in their underwriting and in their operations. And he also discusses how less experienced players get complacent during good times in a way that can lead to critical failures when times turn bad. We also discuss how assumable loans appear to be artificially propping up asset values in some cases, and you'll also hear us discussing the risks and benefits associated with bridge loans. David also discusses how passive investors, limited partners, can prepare themselves for the quick decision-making they're going to need to take so that they can benefit from the likely stream of discounted assets headed our way in the months ahead. Now, these podcasts are all available on all podcast channels and also as videos on YouTube. You'll find them, if you find them of value and you enjoy the conversations, please like them, right? Click the like button. And ideally also, please post a comment, particularly on YouTube or on LinkedIn, wherever you see it. I get email notices whenever somebody posts a comment and I will respond. There is also a podcast page with more information about David and his company at the Gower Crowd website. And while you're there, subscribe to our newsletter, which covers the world of real estate, syndication of crowdfunding with a focus on how to navigate these turbulent times. All right, you ready? My first guest in Series 5 of the real estate reality show. Here's my conversation with David Saxe, managing principal at Calvera Partners. Dave, thanks for joining me today. I wanted to ask you, posted a couple, maybe I put a couple of interesting posts on LinkedIn, and I'm going to read one of them to you, and then I'm going to ask you a question. So the first one that you posted was I'm going to quote it: "The rise in multifamily cap rates is slowing." And you guys, or your post, you said, cautioned against being overconfident, noting that you agree with Beacon Economics that cap rates are at best a rough approximation and estimates can vary pretty widely from property to property in a rough market. So let's back up first and talk about cap rates and the correlation between cap rates and interest rates, which of course is where this whole discussion starts. So just tell me what your thoughts are about that correlation between interest rates, the rise in interest rates, and cap rates going up.
Right. And so as interest rates are going up, so your cost of borrowing goes up. When we put potential deals in our financial models, when I program in a higher interest rate, so it costs me more to get a loan to acquire a deal, I am going to require a higher yield on my money in order to make the deal work. So therefore, the cap rate or the yield on year one, NOI divided by the purchase price, has to go up in order for me to get the return that I've promised to my investors. So they're very much correlated historically and absolutely correlated in what we're seeing in the market right now.
So what actually, but then what does that mean in terms of values? I just assume there's one guy who doesn't understand the relationship between cap rates and values,
absolutely. So when
interest rates and all that kind of thing.
When interest rates go up, we program in a higher cost of borrowing in our model. That means in order for us to yield the same return that we promised to our investors that we're trying to achieve, I can pay a lot less for the building, leading to distress. So something that might have been a 3 cap or really expensive early last year, some of those same deals might be coming back now at a 5 cap, which is a massive decrease in value, 20%, 25%, depending on the building, the submarket, and whether it's a luxury product or some of the older product. It does vary, but absolutely, interest rates go up, cap rates go up, values go down.
All right, but what if somebody 2 years ago or last year, beginning of last year, before interest rates went up, the year before they bought a property and they locked their interest rate? What's the impact then on that building?
Okay, so we have something in our portfolio, absolutely. So we bought a 300-unit building in Chapel Hill area of North Carolina in August of 2021. And we made the decision at that time to assume the loan of the seller, meaning taking on their loan instead of getting a new loan. Well, at the time when we made that decision, the interest rate on that loan was 4.13%, which at the time was above the 3% or whatever you want to call it, 3.5% interest rate I would have been able to get on a new loan for the acquisition. Well, now when interest rates have shot up above 6, we're sleeping well because our cost of borrowing or the amount we pay in debt service to the lender every month is understood, and it's staying at that 4.13% level. So that allows us to continue to work the revenue up and not worry about a hit to cash flow from having to refinance or from having a loan at a much higher or even floating rate interest rate, which would crush the value of the building, potentially even leading to a distressed opportunity and forcing people to sell, which is what we're seeing right now.
Okay, so that's interesting. So what has happened to the value of that property? I understand that for you have a downside protection because you got a locked loan. And I would like to know the term of that loan, right?
Sure.
Because presumably it's got a maturity. But has the value of the property gone down irrespective because cap rates have gone up and values have come down in general?
Generally, values across the market have gone down for the reasons that you mentioned. However, there's an exception, and this is what I'm seeing in a lot of the broker materials on the market right now, is all of them, when possible, are playing up the ability to assume an attractive in-place loan. So, for example, if we were going to go sell the North Carolina building tomorrow, assuming the loan docs allow for it, and many of them do, some don't, we would market that as saying, you can take on our loan as well, and you can have the 4.13% interest rate. So hopefully in our case, we're not looking to sell, but when we would, it wouldn't necessarily be that impactful on value. Other things that could impact it, obviously, unrelated to that, would be where rents are in the market and other things like that, just cash flow. But that's one example of what we're seeing in a lot of deals that are listed in my inbox every day is assume this loan, and you won't have a hit to the value. That's how I would explain it.
And they're still trying to sell at what, early 21 values, and by justifying that, well, you're getting this low.
Correct. Yeah. Now, what we're seeing out there is, there's still a lot of what's called bid-ask spread. So let's say a family, this just happened to us. We put in an offer. We tended to sit on our hands and not put money out last year because we thought things were overpriced. And that's what we were trained to do with our institutional backgrounds. But this year, when we started putting in offers just in the last month, for example, on a deal in Austin, this is great. We had the top offer. but it wasn't clearly a group that was in distress enough, because when they saw our top offer, they pulled the deal from the market. So it really depends. How much distress depends on the specific circumstance of the group involved. It's not always really distressed. Sometimes it's a valuation exercise. But yeah, we that's how you get the best deals is you wait until there's distress. You stick to your conservative underwriting. You make an offer at what you think it's worth. And sometimes it'll hit, and sometimes the family might pull it, like in this case.
Right, or the seller might pull it.
Yeah, the family was the seller, yeah.
So, so what is typically the term of loans that you're seeing that are assumable? Because that's really important. If it's 6 months left, it's like...
Oh, sure.
Yeah.
Yes, well, you never know what a broker might market until you dig in. You got to dig in and read the docs would be my first advice. So just because it says it's assumable and the implication is that you're going to step into it for 5 or 10 years, that may not be the case, just FYI. In order for it to make sense for a buyer to do it, and for the value, for the loan to be worth something, the value of assuming that loan, yes, to your point, there has to be a lot of time left. So for example, in our case, from what I remember off the top of my head, when we assumed that loan in North Carolina less than 2 years ago, there was 7 years left. It was interest only, meaning we're only paying interest payments and not amortizing payments, which also increases cash flow. And it was fixed. So we're not dealing with a floating rate loan. It's 4.13% fixed. So to your question, in this case, I think there's still something like 5 years left. That's interesting, right? That's much more interesting. You can ride out the cycle with some predictability. To your point, yeah, if we were looking at a deal and there were 6 months left on the loan, yeah, that wouldn't be interesting.
It's meaningless. So you underwrite based on the 5 years.
Correct.
So in that circumstance now, we're moving into a period of distress, clearly, and there clearly is distress in the market. Are you playing defense, or is it a valid strategy to play defense on an asset that you've bought with a low interest only loan, and to use actually the cash flow to self-amortize? In other words, to pay down the debt, just in case in 5 years, if you're planning on holding it or the market is, so that you don't have that, that refi problem that you've got to come up with a huge bunch of equity in 5 years' time. Is there a case?
Oh, and that's what's leading to a lot of people to sell right now. So what we are doing when it comes to defense, I would say, and what we've always done, is less paying down the loan early or making amortizing payments. But we talk every day with aggressive asset management. So we play defense in that we are talking to our folks on the ground. What rents are you getting? Could I get a pop and increase the value of the building, which is another way to play defense, by renovating units now? Are you getting 3 bids on every contract that we're signing on the expense side? What we have found both in our now and in our history at a larger company prior to starting our own group is that people, when times are good, this isn't us, by the way, but I've seen this happen. People start to slack off on the asset management. And so what that means is are you paying attention to what's going on in your building, or just riding on the fact that cap rates are at 3% and you can sell for a huge number? Because when it changes and you haven't been aggressively knowing what's going on at your building, it changes fast. So yes, to finish, we are playing defense, but it's mostly on keeping expenses down like we've always done as much as possible, and seeing opportunities to expand the revenue side so that in 5 years our building has increased in value and we'll still hopefully do great.
Interesting. So under what circumstances is an assumable loan sale, right, with a good long tail on it, and under what circumstances might that be distressed? Is that because the sponsor has not been paying attention to operations, or how could that be distressed?
Okay, I've got a number of different, things on the top of my mind on what can lead to that. We definitely just covered one, and I saw this firsthand at companies I've worked at, where people were asleep at the wheel. They didn't have an asset management department. You buy the building in your model, and then you think you're good, and you just kind of put the model in Dropbox or whatever your folder is, and you fall asleep.
Never
and
look at
5
it
years
again.
later, we got
Right.
a problem. So operation, people falling asleep at the wheel operationally. Another thing could be just softening rents. And by the way, you can see when all these things are combined, it's really a problem. Softening rents. Rents are not going to go up forever. When I started my company in 2010, particularly here in Silicon Valley, they went up for a long period of time. I mean, I don't think I ever had to write a newsletter for my investors saying rents went down for like 10 years. That's not necessarily normal. There are cycles. Rents go down. There's been insurance increases. We're seeing that across our portfolio where folks are having to buy, or just insurance in general. Buildings get older. Different things happen depending on in your market where that happens. This would go into the category of bad asset management, but not enough reserves. So do you have enough capital that you've set aside from your investors up front so that if things go bad, you can weather the storm? An example in my home state here of California would be this eviction moratorium we've been facing in the East Bay, where it's just now hopefully coming to an end here in the next couple months. But an example would be an eviction moratorium where you're not able to do anything, even if someone has a full-time job, they don't pay rent, and the government stopped writing checks to landlords a year ago. Well, we have reserves in our fund because we're conservative, so we can weather that storm until the eviction moratorium ended. So that would go into the category of reserves and I guess government action that you couldn't put in your model. So, and then just generally bad underwriting. So an example would be, we were always trained to use, assumptions you can defend. That might sound crazy, but I think we're sometimes one of the few groups that actually put a rent growth assumption in our financial model that's based on historical fact and not assuming that rents grow 15%. Even if they are now, it doesn't continue on that.
Oh, I see. So hang on let me just pause you there.
Yeah.
You can't seriously be telling me that you've seen models where people are assuming 15%.
I've seen 7 to 10 to 12 when that's been happening year over year over year. And that's not just from in the broker packages, which their job is to get the highest price possible. I get it. Our job is to dial that back. But the way these deals got done is you had to assume that was going to kind of keep happening going forward. I did exaggerate. I don't think I saw 15%.
Okay.
But the way we were underwriting back then was 4%, right? So even if someone was using 8%, which I definitely saw, that's a massive difference in what you can pay. Mm-hmm. So the way deals got done, particularly last year at 3 caps in prime markets, was you juiced or maxed out every single assumption in your model, financial model, to make the deal work at a big value. Those are the deals with all these factors I've described that now are coming back at much lower prices because people have to get out to repay often their bridge loan on top of the senior loan that they got.
How do you determine what is realistic? So actually not just you, but in general, what does a prudent sponsor do in their underwriting to determine what's realistic?
So my background, actually, prior to getting into more on the investment side ages ago, my first job in real estate was actually on the research side at Equity Office Properties in Chicago, with Sam Zell's company. This is ages ago. We had a group of 6 people that before you could buy a lot of market data, and it's available to everyone now, we would come up with our own financial models, look at historical job growth, look at future supply or new product of new apartment units coming online, construction costs, to come up with models that were based in, like any financial model, in historical fact. So, if you can just buy it, which is great. You could go on to, I don't want to do an advertisement for any market data firm here, but you can buy data, look back at 20 years, see what the average is, right? And then you can at least somewhat, you never know, right? You never know it's going to be a pandemic. You can program that in going forward. And what you'll often see, depends on the market, 3%, 4%, right? That takes into account cycles. If you just program in 8% for 10 years, you're basically forgetting the history of when the market went down, and you're programming in a projection based on just when the market went up.
Exactly.
So this is what we have to do as acquisitions guys, is kind of figure this out. It's tricky, but the rent growth one, particularly around what your exit cap rate is or what you're going to sell for, I think that one's a harder one. But rent growth, we have averages. We can look back.
And yeah, interesting. When I actually worked for Gore Capital, Goodwin Gore, we would always create 3 scenarios: a best case, a worst case, and a most realistic. Is that something that you do?
Sensitivity analysis, for sure. Absolutely. So, running scenarios where rent growth falls to this. I will say in bad times too, you'd say, oh, if it grows to this. But to your point, yeah, you're really trying to stress test your model. So if rent growth falls, if interest rates go up when your loan expires, if inflation skyrockets, another big one that people often make mistakes on is property tax assumptions.
Yes.
Oh my goodness, this is complicated.
It's a huge number.
Yeah. So for California, for better or for worse, without getting into political discussion, because of Prop 13, which basically sets the value of the building used to calculate annual property taxes at your purchase price. It also says generally that value can only go up 2% per year. So from a financial model perspective, California actually makes it very easy to project expenses in a financial model because you follow that law. When we've owned buildings in Texas, for example, and people have gotten in trouble here, they can do pretty much whatever they want in real time or every however many years the law allows to reset the value of your building. So in a market like Austin, where values have skyrocketed, you're seeing assessed values skyrocket. What does that do? Your property tax expense skyrocketed, and now your cash flow went way down. Now, often your rents are going up because, values are going up. But for folks that bought deals and say in Austin wanting to cash flow at a great rate, their cash flow just plummeted. So sometimes you'll just see people I've heard of, particularly folks that hold for long term, that didn't program that into their financial model. The last point I'll make is, I think the dirty secret is that you kind of have to go with the pack if you're going to want to win a deal, though. So if I programmed into my model every potential increase in value in a market and increased my assessed value in my model, I'll never win a deal. So there's some sort of happy medium that goes into all. Well,
that's the risk. That's your risk delta.
The happy medium, like you have to. You can't be so conservative that every single assumption is as conservative as possible, because you wouldn't have a business.
Yeah.
But you can take a more conservative approach, I'd say, like we do, to kind of land somewhere in the middle.
Now, you talked about bridge loans. Are these, discuss those a little bit more, bridge and pref equity and mezz debt and all this kind of thing, and how that can be hazardous to one's health.
Yes. So when we
actually, what are they first? Again, for a guy that doesn't know, what are these?
Yeah. Well, starting first, without even getting into bridge first, but normal loans. So when we buy a property historically, every single deal we've ever acquired, we go to a lender. It can be JP Morgan, it can be Freddie or Fannie, the agencies. What we need to do to acquire a building, assuming one does not want to pay all cash, because I don't know how detailed you want to get here, but you can increase your return by borrowing at a certain rate, investing in an asset that generates a yield higher than that interest rate to get what's called positive leverage. So it'll increase your return. So the more debt you put on something at a lower rate in an increasing market, if you get out at the right time, you can really increase your returns. So typically what groups do, like us, is we just put one loan on it, senior loan, a basic loan, which for us on average has been about 60 to 65% of the value of what we're buying, loan to cost, loan to value. The rest is covered with cash. So let's just say 40% equity, 60% debt. If that will still increase your return, but what's not going to happen if you're doing your job right is when the market turns the other direction and rents go down, you're in trouble because your debt payment could be increasing or is at a higher rate. the point is that the math stops working, goes in the other direction pretty quickly. What we started seeing last year when people were outbidding us by 20 to 25% is not only did people put one loan on it, which is the typical loan that we would put on, but they put on what's called a bridge loan, a second loan on top of the senior loan, requiring less cash in the deal. The bridge loan would be a way to get additional debt at whatever interest rate, trying to juice your return so that you can justify paying a price that's at peak pricing. The problem with a lot of these bridge debts, in addition to their rate can be higher, is they are short term. They expire quickly. So unlike the senior loan that we talked about, that could be whatever, a 7 or 10-year loan, the bridge loan could be 2 years. I'm just making an example. Well, okay, in the current environment, all those folks that paid last year 20% more than us have what's called expiring, I'll just call it high octane bridge debt that they need to figure out a way to repay. Well, the problem is that the values of those buildings have now come down significantly for the reasons we've mentioned. And the only way to repay those loans is to sell the building at a bad time, leading to distress. So that's what we're seeing.
Oh, wait a minute though. So, but if they are unable to sell, then
then it's worse.
Bridge loan, right? If they can't get enough, then the bridge loan lender has the right to take over the property. They basically take the property back, provided they keep the first current, right?
Correct.
The
You're 100% correct. 100% correct. So that's the worst case scenario that you're seeing a lot. Well, we've actually, in the last few weeks, there have been articles, even in the apartment sector, big portfolio, I think got foreclosed on 33,200 units, to your point, in Houston. I don't know if that was a bridge debt, but they were in trouble.
3,200. I think it's 3,200. 3,200.
Okay, 3,200. I'm not sure what I said. Point being, though, to your point, like that's the worst case scenario. Correct. If you can't sell it for whatever reason or at a value that you need to sell it at, if the lender can take it back, they foreclose on you, take the keys, and you're out of a deal. You're out of
right.
A
so let's just be clear though. Both if you stop paying on the bridge loan, and that could be pref equity, it can be mezz debt. There's all kinds of different ways that money can come in to juice supposedly your passive investors' returns, right? Who basically get wiped out and lose everything. The first person that's going to take over the property is going to be the bridge lender.
Oh.
And so it's a valid distressed investment strategy to make those loans because effectively you can get into deals. So just explain that logic.
Right. That's exactly right. So if you see what I'll just say, for lack of a better term, blood in the water, and you see some group out there seemingly paying what you think to be a very, very, very aggressive price. So examples would be things we saw last year. And they come to you to make their numbers work, and you're a bridge lender. And you say, all right, I'll give you that bridge loan. I wouldn't say it doesn't happen where the bridge lender is thinking to themselves, which I think is what you're asking, that this group is likely going to be in trouble.
You don't think so? Really? You don't think that's a valid strategy during this?
I have no comment on that. But it is a valid strategy. It's a opportunistic funds. That's what they do. Distressed funds. That's what they're absolutely. They're unlike many senior lenders, I would say, that don't necessarily have what they need to run a building.
Well, yeah, banks don't want to.
Yeah, they don't want to, but those bridge lenders say, all right,
right,
you're in trouble. I think you're going to be in trouble a year from now. You're not going to cover the payment. I'm then going to take the building from you. And then they just took the building from you at a very nice price. Right. And they're going to get a nice return, assuming things go well. Oh, wow. Yeah, absolutely. Many groups out there that do that. Office, by the way, is where your office right now, which is the most extreme case. You're seeing articles about buildings 20 cents on the dollar here in San Francisco. I mean, just crazy.
I know, it's incredible.
It's pretty nuts.
Is there any value in those things? I know it sounds daft. I mean, I remember in the global financial crisis, I remember the company I worked for picking up buildings in San Francisco that everybody else had thrown their arms up. Hey, we bought this for $100 a foot. How can you go? The copper's worth more than that in the building, you know?
Right.
So yeah, what is the play with that kind of?
About this the other day, because as I mentioned, I come from equity office. My job in real estate, my first job was after the dot-com crash in 2001, 2002, going through equity office's portfolio and tracking the fall off of the cliff in the rents and thus the values. So in this particular, including in San Francisco, where they owned a lot of buildings, all the prime markets, and if it look, I mean, I love apartments for a lot of reasons, but if you're an all cash buyer, because things are so bad in some of these markets in office, you can't even get a lender to give you a loan. You're going to have to buy all cash. If you have a massive multi-billion-dollar fund and you can go in and buy a prime downtown San Francisco office building at 20 cents on the dollar, and can afford to wait out the recovery of San Francisco, which I believe in over a long period of time. I don't know what that number of years are. I would do that all day long. But only a specific type of buyer with a deep pockets that can pay all cash.
Well, it's not just the deep pockets, is it, Dave? It's also the ability and the willingness to sit on an asset for the long term. It's this, you're not looking for a quick buck in this case.
And you're not looking for, the other key point I didn't mention is you're not looking for cash flow. That's for sure.
Not immediate cash flow.
Yeah, not immediately, because if you can't release up the building for a while, because some of these buildings have lost in downtown San Francisco, have lost a lot of the tenants. So I should have mentioned, not only are you buying it at 20 cents on the dollar, but you're not really getting much in the way of cash until you can figure out a way to lease it back up. So you have to have patience, a belief in your philosophy, or belief in what you think is going to happen in that market, and time. And I would make the bet in certain markets. Yeah.
So you mentioned positive leverage. I have seen negative equity or negative leverage deals getting done. I see you nodding knowingly. So presumably you have. How do those make sense in this market? What's going on when you see that kind of thing?
So this goes down to the bid-ask spread. It also goes down to folks that have a certain philosophy, I guess, on where things are headed. So all I would say to that is when you'll have some folks that are looking at deals right now that you know what your debt is, so you can program that in. You know what current rents are, so you can program that in. And some deals on the market right now are going to have, negative leverage, meaning your return will go down by getting a loan.
Your debt.
However, the viewpoint would be in a market that you think is going to have significant growth, is that you think rents are going to recover. So in your financial model, in a year or two, whatever it is, it depends on the group and the deal and the market. But let's just say they think in a year or in 2 years, rents are going to grow back, so that over time, the positive leverage is going to be great enough over the most of the hold period to make up for maybe a year or two of negative leverage.
And you might also hold the view that interest rates will come down as well, right?
Absolutely right. So you will, we have a lot of debates about that. You could read endless debates and forecasting on that. I have seen deals out there where assumptions are made to make it work, where someone assumes a refinance. So taking out the original loan you get today, once, let's just say you increase the income of the property, the net operating income, and then refinance it in 3 or 4 years. Well, groups like that, to make the numbers work, might bake in an assumption that interest rates, to your point, have fallen back down, and therefore they'll get a new loan, in 3 years or 5 years at a much lower interest rate, which obviously allows you to pay more for the building. So I've seeing it all out there.
All right. So during the global financial crisis, right, when things really started to go bad, I actually started chasing deals. Seriously, fortunately, I sold everything right before the Lehman Brothers crash. So I was wondering what was going on, like everybody else, and kind of similarly how people are thinking now. The way that I looked for deals was to drive around the San Fernando Valley. Seriously. Block by block, looking for buildings that were in stick form coming out of the thing. And I called the borrowers. I figured out who they were. I figured out who they were borrowing from, who their lender was. And I called both to see, was there what's going on and can we buy something? What are you doing to identify deals now? You're not driving around the streets of San Francisco, I'm sure, but are you looking at marketed deals? Are you calling banks? Are you identifying sponsors who you think just didn't do a good job and assessing what their portfolios? How do you do it?
We did the same thing. So myself and my two co-founders worked for a large investment firm in LA, probably around the same time. As young guys in acquisitions, we were tasked with doing exactly what you said, which was looking to how did we figure it out? There's now amazing research companies, databases that you can purchase. You don't really have to leave your desk anymore. The old school way would have been to drive around, of course. So you're going in and you're looking in the databases, and there's many groups out there that sell these databases, and you're looking for loans that you clearly are in trouble. And then you are, to your point, reaching out to those lenders. Another thing that we did too, which was similar, almost the same thing, is back in the day, or I say anytime a deal is marketed, you have to sign what's called a confidentiality agreement, a non-disclosure agreement. Now, back in the great financial crisis, and maybe even today, in that document that you had to sign, it would often say, you cannot go talk to our lender. So basically circumvent the sales process and go just try and buy the loan at a discount, right, and get the deal that way, to our point earlier, like be more aggressive. So, every single non-disclosure agreement we signed up, I had to strike out that language and see if the seller would approve it, because we wanted to be able to go talk to those lenders. That was another way we did it. The other way, to our conversation earlier about a big group that I think we said was selling or had 200 units foreclosed on, we also back in the day and would now, you kind of have a sense of which of those groups are in trouble.
Right.
And it's easy to find what they own. And then you're reaching out to folks there. The one downside of today, though, that I want to make a point on, back as opposed to when I was doing research at Equity Office almost, 15 years ago or more, everyone has access to more information. So back in the day, you could really gain a huge advantage by researching things and doing the hard work. Now, you still can, but it's a little bit harder. So
it's more of a level playing field.
Oh, it's much more difficult with the information flow. So just because I'm doing that with any of this stuff, however many other groups are doing it as well. So
what kind of response are you getting from lenders?
Usually, this was even true back then. I mean, the exercise, even when we did that back then, was it didn't usually go too far. And
I was going to say it doesn't,
but with one exception. With an exception. So my business partner at our previous large firm bought the senior loan at 60 cents on the dollar of a number of smaller, well, not all small, but I don't know, it was 400 or 500 units in San Francisco. There's a number of buildings that added up to 500 units. And that would have been a case where the old company that we worked at did buy the senior loan, bought out the mezzanine loan lender, and then took over these San Francisco apartments at a massive discount and subsequently 5 times their money.
Wait. Why would you buy out the mezz lender? Why not just wipe them out?
There must have been something. I don't remember the history of it, but there was something in the deal I remember, and I didn't work on this one, where you had to, somehow the mezz lender had to get taken out too in order to get access to the underlying real estate. And I don't have since I didn't work on it, but point being is that the conversation got started with, the 60 cents on the dollar, which did happen. And this was rent-controlled San Francisco apartments. Lender probably didn't want to be in the business of owning that stuff. So they were more than happy to do that. It was a very complicated deal, though, because at the time, no private equity firm, I don't think, had ever bought, I don't know how many buildings it was. Let's just say it was 10 or 12 of your smaller rent-controlled old San Francisco apartments, because that was the only way to get access to critical mass. So convincing an investment committee at a large firm to do that was no small task, but it ended up being smart. That I remember after starting my own company, I saw that they 5 times their money when San Francisco recovers. So it does. I want to say it does happen, but it probably just takes, you got to be super aggressive.
Yeah, again, I was brought into East West Bank during the global.
We looked at that portfolio.
Well,
I looked at that portfolio at the company I'm referring to at that time.
Well, then
I don't remember what happened.
Well, almost certainly then we met. Well,
Yeah.
I was always at the end of an email. I never.
Another one though that was exciting really quickly was Chorus Bank. So they had built all of the high-end luxury residential condos in major markets. Now that, if I recall, was a formally marketed process by, I don't remember, the FDIC or you remember that?
Yeah.
And that was distressed, and that you knew you were going to buy it out at a really great price, but it was fully marketed. So all the big 5 private equity.
I'll tell you, you want to hear something interesting? I'll tell
Yeah.
you. So that is a CYA. So the FDIC, you know, they had to be formally marketed. You know what I discovered when I was selling loans for East West Bank? And by the way, we'll talk about a couple of questions finish up. But what I noticed, it was an interesting psychology during that period. And I sold hundreds, if not thousands of loans during that time to professional real estate investors. What I noticed was that anything that was actually marketed by a broker was actually sold for less than when it was not sold by a broker. Why? Because everyone thought, it's been marketed, it's going to sell too much, I'm not even going to bother. Because they were priced out. When it was sold directly from the bank, we got really significantly higher prices because everybody thought, you know what, the bank, what do they know? Right, basically.
Well, just a really quick follow-up on that, because that's a good point, is that I remember back then, we were asking as acquisitions guys to our senior management, you know, wouldn't this offer that I'm going to throw in on this building in the middle of the financial crisis be insulting? You know, and what we were told was offer at what you'd be willing to pay and see if the market would come back to you. And even now what we're seeing is deals, you know, that might have been listed last year that we're following up on. That's another way, right? To your point, people forgot about it. That doesn't mean it's not in trouble still. And to your point, you might be able to get better pricing by just, you know, staying around the hoop there.
Well, you know, here's an important point, and this is actually what I was going to. And let's wrap up with this, but I do want to follow up and maybe schedule another time with you if you don't
do it.
We should talk about notes. That's a whole different world, and the implications of buying notes and how you actually get to the real estate. So let's do that on another podcast, if you don't mind. But let's wrap up with this question. So when you see deals, these kind of distressed deals, it's important that investors, passive investors who want to participate in these opportunities, understand the speed of action, right? The speed with which you have to move. It's very different from a normal market. Just describe to me what a distressed deal looks like, and how you, if you want to win one of these deals, what is the process? How does it differ from a marketed, good economy deal?
You know what's interesting on that is because we play in the apartment space, and because apartments have been a hot asset, well, forever, but in the course of my company leading up to it, we all know where pricing got. I found that the speed you even had to move in what was a non-distressed market was really fast. You had people putting down what was called non-refundable deposits, due diligence periods that weren't anywhere close to 30 days. To your point, where I think you're going with this is generally, though, you have to move quickly when if you want to get a good price and a distressed price, you need to provide surety of close. So meaning that you can bring the cash to the table and you can bring it quickly and take the problem off the plate of the seller or the broker. So I think what you're getting at is you have to be prepared to move very, very quickly, and you may not even have time to go get that senior loan. You may just have to buy all cash and do it later. So the only reason I was kind of laughing is just because apartments are always pretty quick timelines.
Oh, that anyway. Right.
Yeah.
Well, okay, yes. I guess the point that where I was going with this, and this is where I'd like to wrap up actually with one final question. Very important. I'd appreciate your insights. There's a lot of there's a lot of investors who are new to commercial real estate investing simply because real estate syndication or general solicitation became legal since the global financial crisis. So a lot of people who have never had the opportunity to invest in real estate have been exposed to real estate syndications or real estate crowdfunding, whatever term you want to use, and to commercial real estate for the first time in their life. And of course, over the last few years, they have been taught, I don't mean to patronize or be rude or anything, but conditioned to believe this time is different, right? It's always going to go up, and we've got these 25% IRRs and et cetera, et cetera. The world has changed. So for investors listening to this podcast, understanding that speed of decision and action is really critical, but not wanting them to make mistakes. What advice would you give to accredited investors who are interested in the distress world in order for them to prepare to be able to benefit from general solicitation, being able to invest with guys like you and others?
Do your research on finding the best, what's called sponsors, or people that bring these deals to the table. People that you trust, have integrity, that put realistic assumptions in financial models, that do transparent reporting. At the end of the day, you're partnered with somebody on this. You're trusting them with your hard-earned money. You want to make sure you can trust them. If you do that research up front and find the best groups, then you can be prepared to just move when they have something. There's some just what's called bad actors out there, and that's what I think is the most important, very much important thing, and just make sure they know what they're talking about.
David Saxe, managing principal at Calvera Partners. Super happy to have you.
Thank you for having me.
All right, that was David Saxe, managing principal at Calvera Partners. These podcasts are available on all podcast channels and also as videos on YouTube. If you find them of value, please, and if you enjoy the conversation, please like them and ideally post a comment, particularly on YouTube. I do, as I mentioned earlier, I do get email notices whenever anybody comments, and I will respond. I'd love to do that in the comment sections on YouTube particularly, but also on LinkedIn or Facebook, or Twitter, wherever you consume this content. Plus, if you have any war stories about deals gone bad or ways that you've turned bad deals around, email me at adam@gowercrowd.com. I would love to hear what you have to say and possibly even invite you on the podcast to share your experiences. That's it for today. Thank you, David. It was good seeing you again. I look forward very much indeed to our upcoming discussion on non-performing loans, how to buy them and make money investing in loans, or notes as they are also known. And thank you, dear listener or viewer of this video, of this podcast, for joining me today. These are interesting times. I really hope that you found the conversation with David of value in helping you make even better informed decisions. All the best. Thank you so much. I'll see you next time. And for now, this is Adam Gower signing off.